What if the next stock market crash doesn't destroy your wealth, but the way you react to it does? Because here's something most investors don't want to hear. The market doesn't need to give you a warning before it falls. Your 401k could drop. Your IRA could suddenly look much smaller. The retirement you've spent 20 or 30 years building could appear to disappear almost overnight. But here's the part nobody talks about. History shows that the biggest danger during a market crash may not be the crash itself. It may be what investors do after the crash begins. So before you check your portfolio, before you panic, and definitely before you sell everything, stay with me. Because by the end of this video, you'll understand what history has taught investors about market crashes, and the mistakes you may want to avoid if the next one arrives. And if you're watching from the United States, comment the city you're watching from below. I want to see how far the EgoMoney community reaches. The fear behind the numbers. Let's imagine something. It's a normal Tuesday morning. You wake up, make your coffee, check your phone, and something feels different. The financial headlines are everywhere. Stocks are falling, the Dow is down, the S&P 500 is dropping. Your favorite financial channel is talking about volatility, and then you open your investment account. You see a number you've become comfortable with, maybe $150,000. Maybe $300,000, maybe $700,000. Maybe you've spent decades building it, and suddenly it's down by tens of thousands of dollars. Your first thought isn't necessarily, what's the rational long-term investment strategy? Your first thought is, how much more am I going to lose? That's where fear takes over. And fear is powerful because it doesn't ask you to think about the next 20 years. It makes you think about the next 20 minutes. That distinction matters because market crashes are not just financial events. They're psychological events. And when fear becomes stronger than your financial plan, that's when seemingly intelligent investors can make incredibly expensive decisions. Why a market crash feels different when you're 40, 50, or 60. If you're 25 years old and the market crashes, you might have decades ahead of you. You may even see falling prices as an opportunity. But when you're 45, 50, 55, or approaching retirement, a major market decline can feel completely different. You've already spent years accumulating wealth. You're no longer thinking, how much can I make? You're increasingly thinking, can I afford to lose what I've already built? That's a completely different psychological equation. Imagine someone who has $500,000 invested. A 30% decline doesn't feel like a percentage. It feels like $150,000 disappearing. That's why market crashes can be so emotionally devastating. But here's the important distinction. A decline in the value of an investment is not automatically the same thing as permanently losing that money. The outcome can depend heavily on what happens next. And that's where history becomes extremely interesting. The market has crashed before the idea of a market crash isn't new. American investors have experienced enormous market declines throughout modern history. There have been periods when investors believed the financial system was breaking. There have been banking crises, economic recessions, housing collapses, pandemics, inflation shocks, geopolitical crises, and periods when stock valuations became extremely uncomfortable Every generation eventually experiences a moment when people start saying, "This time is different." And sometimes the circumstances really are different. But there's another pattern worth understanding. Markets have historically experienced periods of severe declines followed by recoveries. That doesn't mean every individual stock recovers. It doesn't mean every investor makes money, and it certainly doesn't mean a future recovery will happen on a convenient schedule. But it does tell us something important. A market crash and a permanent destruction of wealth are not necessarily the same event. The bigger question is, what does an investor do when prices fall? The most dangerous moment may come after the crash begins. Picture two investors. Let's call them David and Michael. Both have $500,000 invested. Then the market drops 20%. Both accounts are suddenly worth roughly $400,000. David panics. He tells himself, "I'm not losing another dollar." So he sells. Michael feels uncomfortable too, but he remembers why he invested in the first place. He reviews his plan. He checks his time horizon. He looks at his diversification. And he decides not to make an emotional decision simply because prices are falling. Now here's where things get interesting. Suppose the market eventually recovers. Michael participates in that recovery because he remained invested. David doesn't. Now David faces a second problem. He has to decide when to get back in. And that's much harder than it sounds. Because when markets are falling, everything feels dangerous. And when markets finally begin recovering, investors often feel like they're already too late. So the person who sold because they were afraid may eventually find themselves facing another emotional decision. Should I buy back in now? This is one of the central problems with trying to time the market. You have to be right twice. You have to know when to get out and when to get back in. Don't confuse a market warning with a market prediction. Now let's address something important. You may hear analysts say, "The market looks expensive," or "Volatility is coming," or "A correction may be ahead." Those statements can be worth considering, but there's a huge difference between saying risk appears elevated and saying the market will crash next month. Nobody knows the exact timing of the next crash. Not television commentators, not social media influencers, not financial YouTubers, and not me. That's why you should be extremely careful whenever someone claims they know exactly when the market will collapse. The useful question isn't, "Can I predict the exact day the crash starts?" The useful question is, if the market drops 20%, 30%, or more, will my financial plan survive it? That's a much better question. The $100,000 question. Let's make this practical. Imagine you have $100,000 invested. The market falls 10%. You now have approximately $90,000. Then it falls another 20% from there. Now you're around $72,000. Seeing that number can be terrifying. But here's the psychological trap. Your brain starts thinking, $28,000 is gone. And emotionally, it feels like that money has vanished forever. But the market hasn't necessarily completed the story. The real question is what happens afterward. This is why investors need to understand the difference between temporary decline and permanent loss. A permanent loss can happen when you sell an investment for less than you paid and never participate in its future recovery. That doesn't mean holding every investment forever is wise. Some companies fail. Some investments deserve to be sold. But selling everything simply because the market is falling is a completely different decision. The question you should ask before a crash, instead of asking, "What should I buy if the market crashes?" ask, "Why do I own what I currently own?" This question is incredibly powerful. If you own a diversified portfolio because you're investing for retirement 15 years from now, a temporary market decline doesn't necessarily change your long-term objective. But if you own speculative investments because you believed they could make you rich quickly, a crash can expose weaknesses in your strategy. That's why preparation matters more than prediction. You don't need to know exactly when the storm arrives if you've already built the house properly. And if you're finding this useful, take a second to do something for me. Subscribe to EgoMoney. This channel isn't about making you rich overnight. It's about helping you understand money before money makes decisions for you. And if you've ever watched your investment account fall and wondered whether you should sell, comment "Hold" below. Then tell me the city you're watching from. I want to know how many people across America are learning about money with us. Now let's get into the part that could matter most. What smart investors can do before the next crash. You don't need a crystal ball. You need a plan. Here are several principles investors can consider before volatility arrives. 1. Know your time horizon. If you're investing money you'll need next month, that money probably shouldn't be exposed to the same level of market risk as money you're investing for retirement decades from now. Your timeline matters. The shorter your timeline, the more important it becomes to understand the risk you're taking. 2. Understand your risk tolerance. Here's a simple test. Imagine opening your investment account tomorrow and discovering that your portfolio has fallen 30%. How would you react? Would you stay calm? Would you lose sleep? Would you sell everything? Your answer tells you something about your actual risk tolerance, not the risk tolerance you think you have, your real risk tolerance. Because it's easy to say, "I can handle volatility," until you actually see $100,000 disappear from the screen. 3. Don't invest your emergency fund. One of the worst situations during a market crash is being forced to sell investments because you suddenly need cash. That is why maintaining appropriate emergency savings can provide something incredibly valuable: time. If you have enough accessible cash for unexpected expenses, you may have more flexibility to avoid selling long-term investments during a temporary market decline. 4. Diversification matters. A portfolio concentrated in one company, one industry, or one type of asset can behave very differently from a diversified portfolio. Diversification doesn't eliminate risk, but it can reduce dependence on a single investment or economic outcome. This is especially important as you get older and your financial priorities change. The retirement problem. People don't talk about enough. Now we're getting into something especially important for viewers between 35 and 60. Sequence of returns risk. The order in which investment returns occur can matter enormously when you're withdrawing money from a portfolio. Imagine 2 retirees. Both experience the same collection of annual returns, but one experiences the worst returns right at the beginning of retirement. The other experiences them later. Their outcomes can be dramatically different. Why? Because the first retiree is withdrawing money while the portfolio is declining. That's why retirement planning isn't simply, "How much money do I have?" It's also, when will I need it? How much will I withdraw? And how much market risk can my retirement plan withstand? If you're approaching retirement, this is where a personalized financial plan can become much more important than simply following market headlines. Don't let fear turn you into a market timer. There's a seductive idea that sounds incredibly intelligent. I'll sell before the crash and buy back when everything is cheaper. Sounds perfect until you ask, when exactly will you sell? And when exactly will you buy back? What if the market drops 10% and then rebounds? Do you buy? What if it drops another 15%? Do you wait? What if it suddenly rises 12%? Do you chase it? Market timing sounds simple when you're looking backward. It's much harder when you're living through uncertainty in real time. And that's why a written investment plan can be more valuable than a prediction. The real lesson from market crashes. Here's the uncomfortable truth. A market crash can destroy wealth. But panic can destroy wealth too. And sometimes the second one is more preventable. You can't control whether the market crashes. You can't control inflation. You can't control interest rates. You can't control geopolitical events. You can't control what politicians say. You can't control what the Federal Reserve does, but you can control your asset allocation, your savings rate, your emergency reserves, your debt, your investment costs, your diversification, your time horizon, and most importantly, your behavior. That's where your power is. What if the crash really is coming? Let's say the market crashes tomorrow. What should you do? First, don't make a decision simply because everyone else is panicking. Second, look at your financial plan. Third, separate money you need soon from money you're investing for the long term. Fourth, review your portfolio. Fifth, understand what you actually own. And sixth, if the situation is complicated, consider talking to a qualified financial professional who understands your specific circumstances. Because your financial situation is different from everyone else's. A 58-year-old preparing to retire next year should not necessarily have the same strategy as a 35-year-old with decades ahead. That's why generic advice has limits. The most important thing to remember. Let's go back to that person staring at their investment account. $500,000. Then suddenly, $400,000. Then perhaps $350,000. Fear starts screaming, "Get out!" But before making any decision, ask yourself, why did I invest? What is my timeline? What do I actually own? Do I need this money right now? Has my financial situation changed? Or has only the market price changed? That last question is incredibly important because markets can change dramatically. But your financial goals don't necessarily change just because the market does. The next market crash may happen next year. It may happen years from now. It may be smaller than people fear. It may be worse than people expect. Nobody knows. And that's exactly why trying to predict the future isn't the foundation of a strong financial strategy. Preparation is. The goal isn't to build a portfolio that never falls. That's unrealistic. The goal is to build a financial life that doesn't collapse every time the market does. Because if you've built your finances correctly, a market crash can become a painful period instead of a financial catastrophe. And history has repeatedly reminded investors of something important. Markets can fall much faster than people expect, but fear can make investors make decisions that are even harder to recover from. So don't spend all your energy trying to predict the next crash. Spend some of it preparing for one. If this video changed the way you think about the next market crash, subscribe to EgoMoney because we're going to keep breaking down the financial decisions that can make a difference before you need them. And I want to hear from you. Do you think a major stock market crash is coming? Or do you think the current fear is overblown? Comment crash if you think a major decline is coming. Comment recovery if you believe the market will continue pushing higher. And most importantly, tell me the city you're watching from: New York, Chicago, Houston, Los Angeles, Miami, Atlanta, Seattle, or somewhere completely different. Drop your city in the comments, because the EgoMoney community isn't just one place. It's investors and money-conscious people everywhere trying to make smarter decisions with the money they've worked so hard to earn. And remember, you don't need to predict every market crash to build wealth. You need a plan strong enough to survive the ones you can't predict. I'll see you in the next EgoMoney video.